Well, we're seeing crude oil bouncing back from its lows this morning following a steep decline due to waning demand and a strong U.S. dollar. Currently, oil still hovering around just under that $80 a barrel mark, well below its midsummer highs. Let's bring in RBC Capital Markets Managing Director of Global Energy and Digital Intelligence Strategy, Michael Tran. Mike, it's good to talk to you today. Let's start with that story that we're watching out of Florida right now. We've seen obviously Chevron and BP shut down some of their operations around the Gulf of Mexico. How significant an impact is the storm likely to have when you look at the broader oil markets?
Yeah, I think that the key idea here is hurricanes just simply are not as bullish as they used to be. And the reason why I say that is because I'm old enough to remember Hurricane Katrina in 2005, where it completely ravaged the Gulf Coast and offshore platforms were offline for significant periods of time. So that led to a supply crunch. This is a very different story with Hurricane Ian, in the sense that we have had evacuations from platforms just preemptively. But the key idea is you're going to resume normal operations in the next several days. And the reason why is because these platforms over the recent decades have been completely fortified. So as a function of that, the Gulf Coast is much more ready to take on the impact of storms now than was the case, call it 10, 15 years ago. I think a key factor to really think about here is if this hurricane really leads to stay-at-home measures, shelter-in-place measures, or widespread evacuation measures in places like Florida, this can actually lead to a greater demand destruction event than a supply destruction event.
And is that the case as far as what we're seeing with oil prices recently? I mean, is oil really reacting to demand destruction?
Well, I think what's really fascinating is that there's just so many different cross currents in the global oil market right now. I would say that the market is certainly really reacting to potential recessionary fears. In fact, I will share that I think the market right now is more concerned or more scared of Fed Chair Jerome Powell than the oil market is concerned about escalatory efforts with Vladimir Putin. I think what's really important right now is that there's a lot of different policy cross currents in the market driving the oil price either higher or lower. If you look at the 5 biggest major themes impacting oil price over the course of the past month, and likely to be the case over the course of the next month, you're looking at everything from OPEC policy. A month ago, we were talking about the likelihood or not of an Iranian nuclear deal. You look at Biden and his SPR program. You look at China's zero COVID policy. You throw the Fed in there. There's just so many different cross currents. And I think this has really led to a degree in the market of policy paralysis. The investors just simply don't know what to do with the energy tape. And as a function of that, liquidity in WTI is low, or the broad oil market is low. What you're also seeing is that positioning is also at the lowest point since early days of the pandemic when oil prices went negative. So this suggests that risk appetite is quite low right now, and the policy paralysis just continues to just really reign supreme in the oil market over the course of the past several months, and likely over the course of the next several weeks as well, at least until we are able to de-risk some of these policy factors.
You just alluded to the SPR release. Of course, that is coming to an end as far as we know come October. We're looking at reserves in the strategic petroleum reserves at levels we haven't seen since the 1980s. And the question is how quickly the U.S. government's going to move to refill the stock. What is your expectation on that front, and how is that likely to affect prices?
Yeah, this is a really great question that a lot of fundamental oil traders are really grappling with right now. When the Biden administration came out with SPR releases earlier this year, 180 million barrels, the largest SPR release we've ever seen in history. They provided a very clear timeline. It was roughly, you can do 180 million barrels over the next 6 months, which comes out to be about 1 million barrels per day. Now, the Biden administration has recently come out suggesting that they're going to refill SPR at some point in the future, and they've given rough guidelines in terms of the the prices where they would start buying barrels. So this, in effect, should put somewhat of a soft floor into the market. The problem is that there's no real guidance in terms of real timelines. So we think that this is likely going to be a 2023 event. So there is going to be a tailwind of a lot of buying of barrels back into SPR, but timeline still remains quite fleeting at this point. And this is why the oil market is right now just really focusing on the downside and the recessionary fears that are just front and center at the moment.
Having said that, what does this mean for refined products and the price of refined products? Because we have seen gasoline prices go higher after they had been down consecutively for about 98 straight days. Heating oil as we go into the winter, and we know that we are exporting heating oil and diesel to Europe. So what can you tell us about the refined product space going forward?
I think what's really key here is you have seen gasoline prices come off quite substantially from the all-time record highs in retail pricing that we saw earlier this summer. The key idea here is we're still very tight from a global diesel or heating oil perspective. So gasoline generally wanes coming into the shoulder season. But diesel, as we go into, whether it be winter heating season in certain places like Europe, and we know that Europe is in for a bit of an energy crunch just given the war on Ukraine right now. But diesel prices continue to be quite strong on a global basis. Cracks are strong still across the globe, even though we've seen some weakness over recent months. I anticipate that there's a pretty strong floor not too far from here, just because on a global basis, there's still a shortage of enough refined product. Then also the key idea here is if we have shortages in certain parts of the world, like Europe, heading into winter, the key idea is, are we going to be able to get the right barrels to the right places at the right time? And we all think that's relatively easy to do sitting behind a desk, but logistically, it's always a nightmare. So whenever you have any sort of logistic bottlenecks in terms of getting barrels to the right places at the right point in time, that leads to a lot of potential volatility in oil prices. So I would anticipate that to really be the case heading into the winter.
Thank you so much, RBC Capital Markets Managing Director of Global Energy and Digital Intelligence Strategy, Michael Tran. Thank you.